Okay, what's up, guys? So we are going to be going over something that I think is really important that a lot of people ignore when it comes to trading and also just trading in general. And I think this is something that is a good refresher, but also something that's crucial to help you in your success as trading. Okay, so the first thing we want to talk about is we need to understand that there are market makers, right? These market makers are people that have tons of money and essentially control the directions of the market. So um basically these are the people that manipulate the stock charts. They manipulate whether the stocks go up or down. And a lot of people say that the stock market is somewhat rigged, which it is. So then these are the people that do that. So we have to know this, and we can use this as an advantage if we do know this, because we know that these market makers are out to get retail traders. They're the big money trying to basically just find liquidity. So what I mean by finding liquidity is they are trying to attract transactions to happen within the market. So like the buying and selling of stocks. They want more transactions to happen because that's how they make money. That's how they build up positions. This is how they get out of positions. This is how they build up more open shares for them to purchase, and or more opportunities for them just to sell their stock and get out of the stock, because these market makers are trading in such large positions that they cannot sell it like you can in a single just one transaction. They have to take courses of a strategic period of time of continuing to sell these positions until they are gone, or build up these positions until have reached the point that they wanted to reach, this position size that they wanted to reach. So these market makers manipulate the market in all these different ways to, with the number one objective, to get people, or to basically create transactions. So what does that look like? They want to create transactions. So what does that look like? Let's see. They want liquidity. Okay. So this is the number one thing they're looking for. How they create liquidity is transactions, more transactions in the market, the better. How can they make this happen, right? How do they are able to manipulate prices and change the price of things. So how are they able to create more liquidity, more transactions in the market if they can manipulate it on their own? Okay. So one of the ways they do it is hitting stop losses. Actually, this is the number one way they do it. This is really the main way they get people in and out of the market. Okay. The reason being is because people have to get into positions to have a stop loss, right? You're not going to have a stop loss if you don't have a position. It's kind of like the chicken before the egg, whatever that saying is, So they use these stop losses as ways to knock people out of the market. How do they figure out these stop losses? Well, it's not rocket science that everyone knows. Like if you're looking at this chart, that right here is some sort of support, right? Oh, it's not rocket science that this right here is resistance, right? Like that's not rocket science. Like everyone on the chart can see that this is resistance. Okay. What's another thing? Everyone can see that here is support. Okay. So everyone can see this on the charts. It's not like we're all looking at a different thing. That's how we make trades, right? Everybody is looking at the same charts. Okay. So how can we get out of this and not, how can we make money when these people are manipulating things that we are all seeing, right? So what they try to do is they will drive price up or down in a certain way. So like they might drive price above this resistance level and have breakout traders buy here. Okay. Breakout traders are going to buy this breakout, and people that bought puts on these rejections are going to get stopped out. So that's already two opportunities where they can ultimately stop out somebody. Okay. So when we see this resistance level, we see price, or we say people are buying puts on the rejection, they think it's going to go lower, right? So they will get into put positions. They may be well positioned and this is the right trade, but they might get stopped out because the market makers are trying to do that. So the ways that they can do this is they'll push price above and stop out the people that bought puts at this resistance. They'll stop those people out. They'll have breakout traders buy this breakout. And then what they might do is bring price back down, stop all the people that bought the breakout, and then they might just drive the price right back up again, just so they can stop those people out and then ultimately have the run that they want. What's more than likely, okay? So we're in this situation. So there's two different situations. And so now we need to think about that, obviously. So that's the first thing. We can go more into depth with that, but we're going to build on this whole idea of market makers, right? Okay, so their whole objective is to build liquidity. They do this by hitting stop losses. They do this by, they know where people's stop losses are because everybody sees support and resistance on the chart. So they know that stop losses are going to be somewhere above this support or below, or above this resistance or below this support, you know, like everybody's putting their stop losses in the same general idea. Okay. That's number one. Okay. So that's another thing that they're trying to do. Another thing that we know about market makers is they trade with large amounts of money. Okay, obvious. They trade with large amounts of money. That's how they get prices to move. So one thing that's different about them and me and you is that they cannot get into a position right away. You can buy 15, 20, 30 contracts without it even matter. Like, it doesn't matter. Nobody will know that you bought these contracts. Obviously, we'll show on the tape, whatever, the flow, whatever. But the point is that it's not going to change the stock price drastically because of what you do, unless you are trading with millions and millions worth of dollars, okay? So market makers trade with millions and millions and millions worth of position sizing. They cannot enter into these positions just in one order. They have to do this over a period of time. So these things are called accumulation and distribution, okay? So these are two different things that the market makers do. There's things called accumulation and distribution. What are these? So accumulation is when we are in a downtrend, we move lower. I will show you an example where we move lower and then we chop back and forth in here. We chop and we stay flat, right? No market direction. And then we ultimately break back upside. Okay, so that is accumulation. That's what accumulation essentially is. We will show an example in a moment. But what is distribution? Okay, distribution is when we have a run up in a stock, we have some sort of sideways action with consolidation, and then we have a breakdown back to the downside. This would be distribution. So this is accumulation. This is distribution. They're the exact opposite of each other, but they are two concepts that the market makers use to either build a long position here or a short position here, okay? So now I'm going to delete these little drawings and we're going to go through and look at two examples, okay? So first example is accumulation. This is where, if you think about it, what does accumulate mean? That means you're gathering, basically. That's what, I don't know the exact definition, but accumulation means you are gathering together, whatever, you know, look up the exact definition if you want it, but that's essentially the idea. Okay, so this is an idea of accumulation. We have a strong trend down, and check this out. We have consolidation, back and forth, back and forth, back and forth, no real direction, and we're just chopping back and forth and not really making any sort of move, right? So see this? See how this accumulation, and it can form a pattern. Like this does start to look like an inverse head and shoulders, right? But the idea is we basically will chop, okay? So I'm going to draw basically where this chop begins, And you guys know this. If you look at the lower time frames, you'll see, wow, we're stuck in some chop. Okay, so this is the idea of the chop. Okay, this is where we saw chop happening. Okay, so we had a strong move. This is considered to be accumulation when there's no real direction. We're just going back and forth, going back and forth. And then creating this kind of, this just choppy environment. This is called accumulation, where the idea behind accumulation is when price comes down, hasn't moved down, right? And then sellers are not pushing it lower, buyers are refusing to push it lower. And then ultimately, this is where big money starts to add their positions. You may start to see heavy flow call in this area, heavy flow for calls, right? You might see a bunch of heavy buyers stepping in and buying call positions, starting in here, starting to accumulate their positions. This is accumulation. People are starting to buy up their positions. We want to recognize this because the market makers create direction. So we want to play in the same direction as these market makers. So we see this accumulation. This is most likely where they are going to be buying stock, creating their position, and at the same time trying to get people to get stopped out and things like that. Okay, so what they're basically a few ideas behind this. There's a lot of different concepts that can go into this, but the idea is we have a move down, we're refusing to go lower, and this is most likely where big money is building up their positions. So they will try to create liquidity within these accumulation and distribution processes. Okay, so what do I mean by that? If I delete this and we looked at just this price action that was right here, you would have gone in and saw that we had chop in between that level and right around here, right? So we were chopping in between, we were never really closing below, and say we're only looking at this price action right here. We obviously can start to see that we are in chop based on these time frames, but we don't know which way it's going to break. This is where they can create liquidity and make chop last longer. How will they do this? Well, look, we're bouncing in between these levels for a while, right? Can't break above, can't break above, can't break above. We have the level here. We see a rejection there, rejection there, rejection there. Okay, and then we see this bottom with a rejection here, or a bounce here, bounce here, bounce here, holding, holding. Okay, how do they create liquidity? Breakout traders trying to take this breakout. Now, notice this is a 4-hour candle. So what we're looking at, this is a 4-hour time period. We even closed above this level as well. They create liquidity by having buyers step in and buy this breakout and boom, push price right below and stop them all out. Gaining liquidity. Okay, here's another example. We can't break below, we can't break below. Boom, we break below. They're getting all these put buyers to get in. They're stopping the people out that bought support. Same idea up here. People are buying when they reach resistance. They fake out the break above, stop those people out, get people to buy the breakout, and then push the price right below to fake everyone out. Okay, so calls get faked out, puts get faked out based on this scenario. We move down. We got people in calls, right? We got people in calls. Oh, look, it worked last time. It worked last time. It should work again. We're holding for 2 4-hour candles, multiple 4-hour candles we're holding. Oh no, so they buy calls. Oh no, it breaks below. They get stopped out. They don't want to swing overnight because we had a nice move down. They get stopped out. People started to buy in puts. Oh, we broke this consolidation. We broke down we broke the lower support. They buy puts. Next thing is the next morning, boom, they're stopped out. This is what the market makers try to do. Okay. So, and then we have another situation. Let's move it further out. Oh, we broke out. Look how far we gapped above. Oh, we had a retest. We held here. Just a liquidity grab, just to bring you right back into this consolidation. Okay. We move further. Oh, we broke back below support. Fake out. Nope. We're actually going lower. Boom. Breaks down. You're stopped out. Again, it's just this constant vicious cycle of where we are in this chop. And that's why it's so hard to trade it, is because market makers are creating this chop zone so they can accumulate a position for where they want price to go next. They do not focus on the 5-minute time frame. They don't focus on the 30-minute time frame, not even the hourly, not even any of those. They focus on the 4-hour, daily, weekly, monthly time frames, the bigger picture time frames. They don't want to catch these itty bitty moves that you see all these gurus doing on Instagram. They don't care about those moves. The big money makers or market makers want to trade these bigger moves and catch 100,000% gains. That's what they're looking for. If they're going to put $1 million into something, they're going to make that money work for them. Okay. So that's the point I want to get across. So a lot of people are spending time on these lower time frames. Market makers aren't even looking at that. So the biggest people in the game are looking at these bigger pictures. So why wouldn't you be looking at them also? Okay. We're trying to beat these guys. So why wouldn't we try to be on the same wavelength as them? Same idea, same ideology, right? We're competing against them. We want to move with them. We want to be swimming beside the sharks instead of being in the path of their destruction. That's kind of a lame example, but it's the best one I got for you right now. Okay. So how can we notice that this is a accumulation or distribution, right? Obviously, there's a ton of chop. Next thing you're going to notice is a lot of liquidity grabs. Let me point them all out to you. This whole thing right here, liquidity grab. This right here, liquidity grab. Another liquidity grab. Okay. Let's see. Here's another one, liquidity grab. They're going to have all these opportunities to fake people out, to get people stopped out and create liquidity, make market transactions. They are creating transactions. They're creating more liquidity by making more transactions, by stopping people out and getting people in and out of the markets, having wrong trade ideas. Okay. So then they can, once these people get stopped out, they can buy more of the position up. Okay. You don't think when they get all these people buying calls, right? They're not if you're buying, if you are on the side of buying, someone is always going to be selling. If you're on the side of selling, someone always has to be buying. It's a transaction. It has to go both ways. When you go to the store, you're not buying something and they're not selling you anything. You're not buying something from them and they're not selling anything to you. It's an equal transaction. They are giving something to you and it's just how the market works. Trading. It's literally a trade. You're trading, you're buying this and they are selling it to you. So everyone has to be on each side of the transaction. So you don't think when this happens up here that they're not loading up on put positions for the next day? They're going to be loading up on those positions, getting all these transactions happening and then stopping them all out. But ultimately what they're mainly going to be doing, this is a smaller move, right? But it still was a move. They're going to be focused on this right here. This was CPI. CPI news came out. They pushed price way below, stopped all these people that were long because there was a distribution phase or accumulation phase. There's all this chop. They're thinking price isn't going lower. We're about to push higher. Prices refusing to go lower, which is the right way to think. But market makers are going to come in, stop all those people out that were well positioned, and then boom, push the price higher. And when they push the price higher, people are going to buy calls. And then check this out. They're going to have a push down, scare all these people out, and then they're going to make the move up, right? They're just trying to fake you out as many times as you can until they're ready to make the move. And they've built up enough of their position. The main point is they've built up enough of their position to the point where they're ready to say, okay, let's move this stock. I've built up this amount of position. This is how much I'm in, and that's what I'm ready for, right? Okay, that's it. And this is a huge example. Like they for sure pushed the price down just to stop all these longs out because they had the right idea. But no, it doesn't matter if you have the right idea. They want you out so they can make the money, right? So many transactions happen this day. And then boom, push the price higher. Here's another example. Before we saw this price action that happened here, clear chop zone between here, clear resistance level, clear support level. We're holding, we're bouncing in between, right? Oh, we had a break above. Boom, just to get stopped out right away. They did that on purpose, like they did that on purpose. Same idea. Oh, we failed the breakout. We're definitely going to push lower now. Uh-oh. Gap up above, and then certainly people buying calls, and then boom, we just broke down. Now this is what I would call, at the looks of it so far, This is a distribution phase where market makers are getting into their selling position, building up a selling position for it to move lower. How can we decide? So those are two examples of accumulation, distribution. This is probably the simplest example of distribution. Building up a selling position, boom, to push it lower. Wide range, but here, building up a position, accumulation to go long. So easiest way to put it, these consolidation phases are the point of this is where market makers are building their position, and we're about to go one way or the other, right? So then it's your job to figure out which way we're going to go. This is the idea. Hint. Hey, market makers are getting in. We're building position now. Figure out which way we're going to go. Figure out which way we're going to go. Figure out which way we're going to go, and then you roll with it. How can we do this? Well, a lot of the time, market makers are making their decisions off the bigger time frames, like we talked about. So let's go to the weekly time frame, and we are going to highlight all these accumulation distributions and see if we can figure out how we decide which way it's going to go. Okay, so this is the 4-hour time frame. This is the lower time frames they will be looking at, one of the lowest. So let's go look at the bigger ones. Weekly. We're in an uptrend. Higher high. Higher low. Higher high. Uh-oh. There's a higher low. Oh, couldn't create a higher high. So what does that mean? Nothing yet. It just means the trend is weakening, okay? And then we broke down and broke this higher low, which is signified right here. We broke this higher low. When we broke this, that means the uptrend is no longer intact. It is now considered to be, we're not in a trend. We could be starting a downtrend. This is when you start to look for puts. Oh, we push back up, the retracement to stop all the people out that were trying to get in on this breakdown. And then we ultimately push lower. Okay. So now we're looking at this. We notice we're in a downtrend. It's obvious. Okay. So look at, we could have told this distribution phase because bearish candlestick pattern here. We're right at key resistance right here. This is a key resistance level that was support and is now resistance. Okay. And it was a pretty obvious rejection. Okay. So next time we're chopping around, look at the weekly candles, bullish candles. That's our first hint, or one of our hints. And we're at a clear support. We're at a clear support level here. We're at a clear weekly support level. This gives you the idea and helps you figure out which way the market's going. Okay. Looking at these bigger time frames will help give you a hint if you understand market structure. That makes it a lot simpler. Okay. So right now we're in a phase of higher high or lower lows and lower highs. Okay. So we're continuing this structure. And right now it's looking like this distribution phase. We had a hangman candle here. We had a bearish spinning top candle here. We had a bearish engulfing, and now we had a shooting star. I mean, it doesn't look, you can't get much more bearish than that, right? We're looking at these larger time frames, and this consolidation, we can see it on the lower time frames. We can see the consolidation on the lower time frames, and then we can go to the bigger time frames for direction of where it will probably go. And then we can go to lower time frames that are, so we can get our entry. Okay. So this is the idea of understanding what the market, like understanding how the market makers work in simple terms, and sorry, and then understanding where it could go next. So, I mean, that's kind of all I wanted to break down for you guys, how the market makers work, because they are the leaders of the market. They manipulate price, and how they stop people out, how they fake people out. But also, when you see these accumulation and distribution cycles, we can look at the larger time frames for context. And all this comes down to just playing market structure. Like if I clear all this off, it's all about market structure. Like you can see this. Like I'll run through it right here. We create a higher high, higher low, higher high, higher low, higher high. Tried to break this lower low on the trend. We tried to break it, failed, but then we broke it. If you really want to get technical and really want to look at this, here's the higher high. There's the higher low. Higher high. So this is the next one to break. As soon as we broke this higher low, we ruined the downtrend. And you can see we broke down, retested it perfectly, and then had to move down. Came to fake those people out, and boom, we had a nasty move down. But you already knew that this downtrend was created when this higher low was broken. Okay, if you haven't learned the market structure, there's an in-depth video in the signals chat. If you don't have that, make sure you go check it out. But this is really all I got for you guys. I just want to break down market structure, break down how the market makers think, break down how they accumulate positions, how they get people out of positions, yada, yada, yada. And also really hone in on the importance of the higher time frames. If I could make any suggestion to somebody that's new or even a veteran in trading, right? Just stick with the higher time frames and it's going to do a lot of good for you. You know? Okay. Thank you guys for watching, and let me know if you guys have questions, and Merry Christmas.